Hello everyone, this is Professor Fang. Today I'm going to share one of my favorite bullish option strategies, the bull call spread. This is a strategy I use when I'm bullish on a stock, but I don't want to spend a huge amount of money buying the shares, and I also don't want to pay massive premium for a single call option. In other words, I want a big upside exposure, but with a small budget. Today, I will use a real example. I actually did it yesterday on ServiceNow, the ticker symbol now, on how I implemented bull call spread. So first of all, what is a call option? So for short, a call option gives you the right, but not the obligation, to buy a stock at a fixed price before a certain expiration date. That fixed price is called a strike price. For example, imagine ServiceNow is trading below $100 per share and you buy a ServiceNow call option with a strike price of $100. If ServiceNow later goes to $150 before expiration, your call option becomes valuable because you have the right to buy ServiceNow at $100 while the market price is $150. So if you are bullish on the stock, buying a call option sounds very attractive. But there's a problem. Call options can be very expensive. You're not only paying for the intrinsic value of the call, but also paying for time value of the call. So the question is, can we make a bullish bet with option, but with a reduced cost? That's where the bull call spread comes in. So what is a bull call spread? A bull call spread has two parts. One, you buy a call option at the lowest strike price, you pay the premium. Then you sell another call option at a higher strike price, you gain premium. So instead of only buying a call, you are doing two things at the same time. You buy a lower strike price call to gain the upside exposure, and then you sell a higher strike price call to collect the premium and reduce your cost. The trade-off is very simple. Your cost is lower, but your upside is capped. That's the key idea. So a bull call spread is not for people who believe that stock will go to the moon with unlimited upside. It's for people who think that I believe this stock can go up meaningfully, like 2 times, 3 times, but I have a target range. I don't need unlimited upside. I just want a good risk-reward setup. It seems to be pretty abstract. Let's go over an example I did yesterday on May 28th. At the time I made this trade, ServiceNow was trading around $105. I was bullish on ServiceNow because the market now is very worried that AI replaces traditional software companies. I understand that concern, but my thesis is a little bit different. I think AI may not replace companies like ServiceNow immediately. By immediately, I mean 3 to 5 years. But instead, AI may become a powerful layer inside the enterprise software platforms like ServiceNow. ServiceNow already works deeply with many large enterprise customers. Replacing it is not easy. These systems are embedded into workflow, their compliance, IT operation, HR, and the whole business process. So my thesis is the following. If the market later realizes that AI is not destroying ServiceNow, but actually strengthen its platform, then the valuation multiple could recover. And the revenue may continue to grow significantly because of AI, and investor sentiments may improve, and the stock could be much higher. But I'm not saying that the ServiceNow is going to the moon like a 10x, because ServiceNow is already a $100 billion company, and I don't see any reason that it can be 10x within a year or two. So with this thesis, I constructed the bull call spread. I buy the $90 call and sell a $280 call with both expiration day on January 2028. And the spread costs about $37.5 per share. So remember, each call option contracts controls 100 shares. So one spread costs actually $3,750. I bought 5 spreads, so the total cost is $18,750. Remember, this is the maximum loss I can get on this trade. So the results is like the following. By the time this bull call spread expires, if the ServiceNow price is below $90, I lost all my premium. So I go to 0. But that's all I lose. And the break-even point is actually $90 plus my premium price, $37.5, which is $127.5. If in the January of 2028, the ServiceNow price is $127.5, so my trade has no profit and I don't lose anything. So that's break-even point. So, and beyond that, any price that is higher than $127.5, I start to make money. So let's look at anything higher than $127.5. If by the time of expiration, the stock price goes to $150, which is a roughly 50% increase from current price, my total return is $30,000. Remember, I already paid the premium. So my profit is $11,250. So how did I calculate this? First of all, how much money you make is 150 minus 90 and it multiplies 5,000 shares. Remember, I bought 5 of those spreads. That's the total money you get. You subtract the premium you paid. I paid $18,750. So that's the profit you get. So remember, I sell a call option at $280. So the profit will be flat beyond 280. So how much I made at stock price of 280? So eventually I totally get $95,000 back and subtract the premium I already paid in upfront. My total profit will be $76,250, which is a very decent profit, right? Here are 2 things I want you to think about it. Why I choose expiration date of January 2028? Why not earlier? I have 2 considerations. First of all, the sentiment on software company can change, but that takes time. So I want to give the market enough time, 1.5 years, to realize that AI is not replacing ServiceNow. Maybe the next financial statement can show that. So you need time for the value to recover. Second, think about the tax. I live in the United States. If my book or spread expires within a year, I have to close this within a year. So even though I make a lot of profit, I have to pay taxes at the rate at the short-term capital gain. So if my expiration date is longer than a year, I can close it longer than a year. So eventually any profit I made, I pay at the long-term capital gain, which makes my tax much lower. Finally, I want to compare 3 comparisons. One is book or spread, one is a single leg call option, one is a holding stock, using similar amount of money, which is around $19,000, right? Let's look at this. So first of all, if you compare the book or spread and the call option, you will find that the call option break-even point is higher than the book or spread, simply because you paid higher premium. So in order for you to recover that premium, you need the stock price to go higher. But think about it, up to $280, my profit for book or spread is higher than single call option, but I have a cap on my book or spread. So eventually, if the stock price go to $350, my book or spread have a lower profit than single call option. So I intentionally set a cap on my book or spread. If I hold stocks, you will see that the good news is that it's very linear. The break-even price is at $105 and everything grows linearly. So if you look at this chart, my return will be better than the other option if the stock price eventually go between 140 and 280. So that's my guess. I think the price will lie somehow between this range, and I use book or spread to maximize my return. So if you have any question, leave the comment below. If you are interested in other option strategy, please let me know. I'll do a video on that. I'm Professor Fang. I'll see you next time.